then you therefore you arrive at the judgment that this is the principal or this is the most advantageous market. Right? So that documentation will need to be there in the file. And then we face a case where there is no observable market. Say I am building the Virgin Atlantica, which will be going to the Mars. I'm sure they have now announced public sale of seats to that. It's a one-way ticket to Mars. Richard Branson has already announced, although his first launch was a failure. So the ones who are wanting to take that one-way ticket to Mars, I'm sure a number of girls here will want to do that. Right? That is open, but there's no observable market for that. Right? Because this thing has never been done before. Or you come out with a new innovation of some new product, innovative product, which didn't have a market at all. So there is no observable market. In that case, you will have to create a hypothetical market. Right? What is a hypothetical market? Basically, you find out what is the kind of price people would pay for it, what is the probability of it happening, and therefore what should be the expected cash flow from it, and then you, based on the probability, expected probable cash flow, and you create it for that market. But I'm sure very few of us would face this, but the standard has taken care of it. Will you be sharing the presentation with them or no? Right, you will. Okay. So I've just added one more example for you because I believe Nitesh will be sharing this presentation. It's no use repeating the same thing again and again. So I've just, for your future reference, I've added one more example which you can read. Now we understood about the asset liability. We've understood about the market market. Now we are talking about a market participant. Who will be the person, or who is going to be the one whose value we are going to consider. So the market participant needs to be independent and it needs to be knowledgeable. How do we create this? We have to create one market participant based on the asset liability principal market, etc. In your working papers, for each market identify 2 or 3 market participants who could be dealers, who could be buyers, who could be other companies of similar nature, because the value that you're finding out is based on the value these market participants give. So normally what you take is comparative data from economic surveys, etc. of the same industry, and then you take that data and you call them the market participants.
In the example, there was a term called CU. Can you define that?
Currency unit. Because I internationally train in number of countries, I can't keep adding AED or dollar or pound or euro, so I just put CU. CU means currency unit, whatever the currency unit of the country. Is it there? Yeah. So now we find out the market participants. For each step, a separate documentation needs to be maintained. For IFRS, anywhere and everywhere, across all standards, every step you do, document. Your entire documentation forms a part of the notes to the accounts. Okay? The crux of those documents. Now, fair value is the current exit price. We already discussed about this, that I need to look at the past and project into the future. Okay? And when we are talking about the current exit price, It says the exit price concept is based on current expectations about the sale or transfer price from the perspective of our market participants. So again, what the market is willing to pay or what the market is willing to do, from that angle we have to take it. But if you're on level 3, then normally you equate that what you do is what the market does. Okay, unless you are not in trend with what the market is doing. Now for the non-financial assets, you're saying the highest and best use. We already discussed it should be physically permissible, possible, legally permissible, financially feasible. And when we are talking about the highest and best use, I'm taking the highest and best use not by me, but by the market participant. Okay, so whoever the market participant, if he does a better job than me, then in that case, I need to take his back. Now here comes the major challenge. When we are creating this, how do I know the highest and best use somebody else will be making?
Market practice. Market practice.
You see, it is human nature to believe I am the best. If somebody tells me, except of course for certain items like cooking, if they tell me of my area of work, I will always say I am the best. Unless somebody else can prove to me I am not the best. Isn't it? So when you are working in your industry, in your company, unless you have signs of deterioration being shown by the company, unless my net worth is depleting, I am showing signs that I am degenerating, can't I say I am the best? Who can prove I am not the best? Of course, I am going to look at competitor data, but publicly available data is only what I can look at. I can't look at the nitty-gritty operational data of the debtors, of the competitors, right? And every company, even in the same industry, has different unique scenarios. So we can always argue out that no other company is like me and I am the best. In the given situations in which I am operating, this is what I am doing is the highest and best use. Am I dumb that I don't do it in the highest and best way? You can always argue it out, right? Which company will not like to use its assets in the best way it can? Because if you don't do that, it's going to be an unending tussle of finding out which is the highest and best use. Unless there are visible signs of deterioration. And if you admit as a company that you don't make the highest and best use of your assets, what do you think will happen in the next AGM? Tomatoes? Probably. No, tomatoes have become too costly nowadays. Probably something else, right? So how can a company ever admit that they don't make the highest and best use or in the given situations of what they are doing? So always say the company does the highest and best use of the assets.
And suppose a drug manufacturing company makes cough syrup. No, a drug addict can pay something else, but we are not going to sell it to drug addicts.
Legally permissible? No. It's not legally permissible.
Sell cough syrup in the market against prescription.
Yeah, but is it legally permissible?
Yes.
It's basically the market share have to be corrected.
And when we are talking about highest and best use, I can't take one unique situation. I need to look at the overall situation. I may probably be very lucky and probably sell one of these items at a very super exclusive price because the person didn't want to settle for anything else. But that's not what is the highest and best use. Okay? Now, when I am looking at this, the first criteria of an asset, it generates economic benefit. That is the Ind AS 1 is telling the definition of the asset. It generates economic benefit and can be reliably measured. Okay? That is the definition of an asset. Is there anything else in the definition of the asset? In Ind AS 1, the first standard, what is the definition of an asset? The asset needs to be held for the purpose of trading. It should generate economic benefits to the company, and it should be reliably measurable. That is an asset. That's the definition of an asset under Ind AS. Okay. Now here it says that it takes into account a market participant's ability to generate economic benefit. Right? So if I have some economic benefit, and here I am fair valuing an asset, okay, which cannot be reliably measured, I cannot take that into consideration, because the measurement of an asset needs to be reliably measured. So suppose I have come up with a after R&D, I have come up with a magic potion which will make me thin, and I am sure everybody thin and healthy, so everybody in the hall would love to get that except her, of course, right? So this magic potion, so in that case it's a big asset, intangible asset, right? But I can't reliably measure it. So the question of fair value measurements cannot come in. Okay? Because it gets restricted by the first standard. Now let us look at this example. Here we are trying to find out the fair value of the asset based on this highest and best use, all other considerations assumed to have already taken. We find two kinds of buyers. There are three assets in the group A, B and C. And we have two kinds of buyers, strategic buyers and financial buyers. Strategic buyers, they are willing to pay for A, B and C those values, 360, 260 and 30. And financial buyers, 300, 200 and 100. Okay? What will be the fair value of the asset for your asset group based on the individual assets? What's the value? For the, what is the value? Who said this now? I'm not very good at verbal calculations because I've grown up in the age of calculators.
720.
720. How did you arrive at that?
360.
A and B will be sold to strategic buyer and C will be sold to financial buyer.
360.
So, in this case, it's an asset group with A, B and C. Each one of them, if they can be individually sold, I will take 360, 260 and 100. But if they cannot be sold unless they are sold in a group, then I cannot break up like that. So the way it can be sold, not the way that you have used it, but the way it can be sold. If it can be broken up and sold, I can take the other first method. But if it cannot be broken up and sold and has to be sold as a whole, then it will go in the single person, whoever is giving the highest score. Let us look at this. Industrial land, and this is surrounded by developing residential complexes, which is really happening now in Calcutta. Every side you see only residential complexes. So you have this industry in the middle and residential complexes all along. What do you think should be the fair value? Should I take it as the fair value with those highest and best use is the residential complex? all the industries are dying in West Bengal. I shouldn't be pessimistic. We are still thinking of a turnover in West Bengal. Yeah. So what should be the highest and best use?
If the industry is not there, then the residential units will not have, will lose its value.
No. Go to Kamarati, give them today the industry land, they will build up in residential units. There's no place to stay. Go to Barakpur, close down the factory, all the builders are more than happy. Go to Bombay, all the mills land, if you give them to the builders in Bombay, they're more than willing to build up residential complexes. They are not dependent on that industry at all. When we face a situation like this, we have to make this test of physically possible, legally permissible and financially feasible. Okay? So, if it is physically possible, depends upon the soil conditions, etc. Possible or not. Legally permissible or not. If it's an industrial land, maybe not. Right? If it's financially feasible or not. Whose financial feasibility?
The buildings.
Market participants or yours?
Market participant, the person who can buy. If he can't buy, then buyers don't have money, then how can you sell? Potential buyers, if they can't buy.
No. Over here we are talking about trying to find out the highest and best use of the particular asset we own. Okay. And we were talking about that I am owning this industry land and the residential complexes can come up over here. They are definitely a highest and better use. Buyers, everybody is there. Okay. Now we are trying to test and see that whether it meets these three criteria. Physically possible, legally permissible, the last one financially feasible. If you read into the basis of conclusions, it is the financially feasible by the company, not by the market participants. It's the market participants can make this highest and best use. To match them, can the company come to that level? If it has the finances, yes, it can come. But if it doesn't have the finances, it's not an option for the company.
Ma'am, here there's a company in Extreme South in Calcutta. They have industrial land where a factory is located. They are considering selling off a portion of land which is adjacent but not used. So there you need to segregate this. Is it possible?
Segregate what?
I mean, one you can revalue it, the sellable portion will increase while the factory of course you can't sell.
Yeah, so that means you're splitting your land, you're valuing one as pure land and one you're valuing as factory building.
That's right.
Right? So when you're valuing the land, then you can take fair value of that land.
Yeah. You need to split it.
But this, you can only do that when the management has already expressed the intention to sell. Does the board meetings include that?
Yes.
If the board meeting has included it, that you are going to split this land and you're going to sell only one portion of land, then you're valuing that as land and not as a part of office building.
Why board meeting and why not members AGM?
See, when the intention, the management's intention to do comes in, at that time you're doing the valuation. When I am going to actually make the sale, then I need the shareholders' approval. So today I will not make that, because if I make shareholders' approval and then later on the management intention can always change. Yeah, and we normally you don't announce it to the last moment, otherwise the employee demands will go higher. business will come down. Right? So this is what we were talking about assets. Now it talks about, you also need to fair value the liabilities as well as the equity instruments. As we already discussed this, we are going to assume that the liability and the equity instruments will be transferred to the market participant, and the market participant will keep that liability outstanding and settle it in due course. And when your own equity is getting transferred, it's not like it's going to extinguish that, you're not going to buy back and write off that equity. It's going to continue as your own equity. Okay? So when I'm valuing that, I'm assuming that it's going to continue with the other person who takes it over. It says application to liabilities and entity's own equity instruments. It assumes that the liability or an entity's own equity instrument will be transferred to the market participant at the measurement date. The liability will remain outstanding and the market participant transferee will be required to fulfill that obligation. Entity's own equity instruments would remain outstanding and the market participant would have the rights and responsibilities and benefits from that equity. Okay? That means when you are transferring it, when you are valuing it, I am assuming that is going to continue with whoever takes it over. Now, this is something I needed to discuss. What is the transfer value and what is the settlement value?
Takes for assets, settlement is for
In context of this, liabilities and equity.
liability is there, we just decide equity can be
Transfer value may not be equal to settlement value all the time. When I am transferring a liability, say I am transferring a creditor and somebody else is taking over that creditor. I have a creditor of 100, I don't transfer the creditor for 100. It may be transferred at a lower value depending upon the credit rating and the credit risk of my own company. So the transfer value and the settlement value may not be the same. Same case in case of debtors, on the other side assets also. When you factor your debtors, you're selling off your debtors at a discount. So the value at which you will be selling the debtors may not be the actual value at which you settle. So that is the reason the transfer value and settlement values may be different. So what I need is a transfer value, not the settlement value which is on my balance sheet. Okay, the values sometimes, depending on the situations, may differ. I faced this in an oil and gas company in Abu Dhabi, where when the company is being taken over, he sold one of their subsidiary companies, liabilities prior to a particular date were not taken over. Right? And then that company, because in the PSA agreements, etc., some of the old liabilities belonging to the ADNOC, that's the Abu Dhabi National Oil and Gas Commission, they had to be transferred to another government department at a very different value than what was there, because that department will then take it up and settle it with the person, end party. So their transfer value and the settlement values were very, very different. So keep that in mind also. Normally, many cases, if it's small companies, it would be the same, but in larger companies, they may be different. Now, there's something called liabilities and equity instruments held by other parties as assets. When a quoted price is available and when a quoted price is not available, two scenarios. When a quoted price is available, then in that case, I will take the quoted price level 1. Otherwise, I will have to look for an identical item with some other part. So suppose it is your own equity shares and it is not a listed equity share. Private limited company, basically. And now you are assuming a transfer of those shares, value of those shares. So how would I find that value out? Very, very critical. Because many private limited companies will be facing this problem. Any idea how will we do this? Because private limited company is not quoted, right? I can give you an idea where you will get the entire procedure. We won't discuss it today because it's going to be very lengthy. But the IASB has issued a very good document on valuation of unquoted shares. It gives you a detailed procedure of how these unquoted shares will be valued with total examples of market multiples and how those calculations are made, and then how the valuation factors will be adjusted for the debts and other liabilities, etc. The ones who want to read it in details, how these unquoted shares are valued, look at that document. I don't think the Indian, have we issued any of those education guidance? Not yet. Okay, I'm sure the institute will be working, but it's ready-made material from IASB site. You can download. Give a Google search, valuation of unquoted equity, IASB, you'll get that paper.
Is it applicable in Ind AS 113?
Yes, it is. Because I have to value all my assets and all my liabilities. So in that case, I need to, when I'm holding an equity of some private limited company as my asset in my books, I need to fair value that. Not my own equity, I'm talking about investment equity. Because many companies, even listed companies, have holdings in private limited companies. There it will be applicable. And if it is not held, we have to go by present value technique and cash flow, basically discounted cash flow technique. We'll just look at those valuation techniques. I'll add out here one more thing. A very common problem in iron and steel industry or mining industries is the decommissioning liability. Decommissioning liability will have to be fair valued. Now, when you are looking at a decommissioning liability, the decommissioning is happening probably 25 years, 30 years hence. Okay? The best way and easiest way to do a fair valuation, because anyway you're bringing them everything down to present value, take present value. Make back calculate all those other things, because that's the present value.
What kind of discounting factor they use for such a long period?
For discounting factor, I'll just come to the discounting factor in the valuation techniques. I'll just come to what is the discounting factor to be used by the companies. Non-performance risk means that when I have a liability that I'm having, and there's a non-performance risk, that means I'm going to default on those liabilities. Okay? Then we have to make a CVA adjustment. That is a credit value adjustment. Now the fair value of the liability is going to reflect our own non-performance risk. When do I make this CVA adjustment? If it's a very good company going on all, please do not make this, because this is an indication to the investors that the company is going down. Risk of the company is increasing. Right? But if you are bound that yes, the risk has increased, then the CVA or non-performance risk adjustment will need to be made for your own credit risk. The figure that will come up, that means you are going to default. Therefore, the fair value of your item liability has come down. So you're making this adjustment. Similar will be a DVA adjustment on the asset side. Okay. So this is something that is very unusual. We always went conservative basis of accounting for asset, where if I felt that, say, debtors I'm not going to receive, I would reduce the value by creating a provision. Now, if the company knows that they're not going to pay the liability, they will reduce the value of your liability. And where does the balancing figure go? Through the OCI. So it's a fallacy of accounting. The second figure has to go somewhere. So in a sense, you are increasing the equity of a company because you are unable to pay off a liability. But that, if you really look behind, that's exactly what you do. Since you're not going to pay this liability anymore, it's a benefit to the shareholders. So that is the entry that they have given us. CVA adjustment, the other side to the OCI. It belongs to the equity shareholders.
And it applies to Kingfisher.
Where is the gentleman?
I don't.
UK, India, US, Timbuktu. You have his address.
I can tell you a company is in India. It's an Indian company.
It's an Indian company, definitely. Now they are having holdings of so much property, etc. So we need to wait and watch what is happening. I am sure the bankers here are good enough, even if the customs officers won't. Right? Again, I have included a very detailed example on this computation of non-performance risk. And it's very simple English, so I'll leave it to you to read later on, right? Because I was telling Nitesh that fair value is such a topic, you can even 4 hours, 8 hours, 10 hours, 12 hours is still short. It's such an expansive topic. So some of the examples, I'm not going through them, but anybody can read it. Somebody was discussing about the offsetting positions. If there are offsetting positions in market risk or counterparty risk, then I can treat it as a group. Okay, there's some exceptions available in there. I think we will come to the valuation techniques. Now, where the standard is saying where there are 3 levels of valuation. Level 1, where you get a direct quoted price. You don't need to think about it, you took the price and that's level 1. Level 2, price with adjustment, observable price with some adjustments. Maybe you found a price of identical item, maybe you found a price of similar item, maybe you have found a price of some other date which is not the current date because I need the current price. So I am making those adjustments. So that is level 2. Level 3, estimated figure. In level 3, you have 3 methods: income based approach, cost based approach, market based approach. Okay. Now the standard says try to maximize observable inputs, try to minimize unobservable inputs. So where you have directly available information which is observable, use those. If you study various industries across the world, in the banking industry I have found most of their assets come on level 2 across the world. It may be JP Morgan, that means an investment bank, it may be a commercial bank, it may be Deutsche Bank, it may be any bank, right? Most of the assets coming on level 2. If you look at a manufacturing company, maybe in the oil sector like British Petroleum, it may be in any other manufacturing, automobile sector, etc. Most of their valuations are coming on level 3. Okay, that's a general trend. By we conducted a research on this, of course, in 2009 when this was getting issued and all, where we found this was the basic trend. In case of service companies, the assets were very, very limited. Most of them were either 1 or 3, because they either had some quoted investments that they had made, otherwise in level 3. So this was the general kind of a trend. Now, for making this valuation, that means we are going mainly the approaches of income approach, cost approach, market approach level 3, or observable quoted items on level 1 and 2. Whichever approach we select, we need to have sufficient data to support that. One-off items is not admissible, except when it is quoted. Okay? And I already said that, use more of the observable inputs. Again, acknowledging the ISB. Okay? Now, when I am going to a approach, which approach to select? When we start working on this, I'll have to start working on all the 3 approaches. Okay? And all the 3 levels. So essentially, at the start, I have 9 options. Then I will make the workings for all these, sorry, not 9 options. You will have 1, 2, 3, 4, 5, 6, 7 options. Okay? And then when you will start working on all these 7 options. Okay? If something is available on a quoted basis, then first option taken and gone. Otherwise, we are moving to the next option of adjustments, if it's a market approach. Otherwise, we are coming to the income and the cost approach. I will work out the workings for all the 3 approaches, because the standard says the management will need to decide the fair value which is most decide the value which is most approximate to the fair value. If you work by each of these approaches, you will come to different figures. You will never come to the same figure. Then you will have to decide which is the most appropriate fair value. Let's take up an example and look at this. I hope the example is here. Say there is an entity and he has acquired a machine in a business combination just to restrict all other past things and all. And the machine is in the highest and best use and it doesn't require customization, so it is the best thing that is over there. So now I am starting looking, what is my data sufficiency? First test I have to make is of data sufficiency. Do I have data for all these 3 approaches? Market approach, income approach and cost approach. So when I am looking at the data sufficiency, income approach, maybe I don't have the cash flows from there, maybe I haven't used it yet, maybe it's not identifiable singly, so I can't take the income approach. So I have, say, cost approach and market approach. I'm just assuming here. Okay. Now in the cost approach, I find out that the measurement reflects the price that will be received for the machine of a similar condition if I'm going to sell that machine. So the range I find 40,000 to 48,000 I am getting for that machine. Okay. Then I go in the cost approach. If I need to substitute that machine, replacement cost of that machine with another machine which will give me the same service, a comparable utility, that's going to cost me about 40 to 52. So now I need to take a fair value which will comply to both these approaches. So the fair value I choose, therefore, can range between 40 to 48. Okay. Now, it can range between 40 to 48 in this example. That's the common area. Now I am going to take highest and best use. So I take the higher end of these values normally, unless you can justify why you are taking a lower value. So the value, you are going to narrow it and you are going to say the fair value of the machine is 48. Okay. So I have to work out all the approaches in my workings. It's not I can select only one approach. Yes.
Madam, one question. Cost, market and income approach is applicable for all the three levels? Or
No. When I am coming to the third level, only this approach is when I am coming to third level. In first level, I have directly got the value, I don't do anything else. In the second level, I got the value, made some adjustments, I don't do anything else. But suppose I don't have observable value and I am working with unobservable data, then I have to compute it under all the three
there
approaches.
will be 5 methods, and you told us 7 methods.
7 options. 5 methods here and 2 there. 7 options.
Where?
In the, why I am saying 7 options here, first market, that is gone. Identical or similar assets with adjustments, that is gone. Now in this you have 3, in level 2 you have 3 options, okay. Observable with adjustments, even in income approach you can have observable with adjustments, in cost approach observable with adjustments. So 3 under level 2 and then 3 under level 3. That's why there are 7 approaches.
If there are some equity shares which are infrequently traded, but the volume is too low. Say the volume is 100 shares only, and I am holding of 1 lakh shares. So how do I value?
Listed or unlisted?
Listed.
Listed shares.
100 trading is 100 shares only on the last day of say 31st.
In that case, what we take is the last traded item and whatever the market value was there, okay. And then we say the information is inadequate because the effort you will take, cost and time line we will see, avenue is too high to justify the, and it is not making a material misstatement, and we just use the figure. All you have to do is justify it, that is not impacting your investor's decision on your balance sheet. That is a very big avenue which has been given to the companies, the cost and time, IS, Ind AS 1. If you can justify that the time taken to get the information and the cost taken is not commensurate with the benefits you are going to get from that information, the investors are going to get from the information, then you can just go by the previous figure saying that this is the estimated figure, we don't have any other information in addition to that. Unless you want to make some money as a chartered accountant and then you advise them go for level 3 and do this and do this and do this. Right, so we did the hierarchy and just put down in a chart for you. This is Deutsche Bank excerpt where you can see most of it is on level 2. You can refer it a little later. And this is how you need to make a disclosure for all level 3 items. So level 3 reconciliation statement will need to be prepared. What is the balance at the beginning? What are the changes on consolidation? What are the losses, purchases, sales, issuance, settlements, transfers in and out of level 3 and the balance at the end. So you can use this. This has to form a part of the working notes. Keeping in mind, the transaction price is always not the fair price. It may be between related parties, duress sales, etc. Then we can't take those. Challenges, identifying the risks. Challenges, making the projections. Challenges, identifying which approach to go to. The challenges, what is the scenario analysis and the sensitivity testing you do for those deviations in the estimated figures, because you have to disclose that. And then what is the probability factor that you're using, why you're using those probability factors for the expected values that you have created. And then finding out the present value, the discounting factor that you use, why you use that factor. Now, the standard says the discounting factor could be the rate of your government bonds. it could be the corporate bond rate, it could be your own cost of capital.
You have the option to choose any of these.
We don't have a corporate bond developed market, so we are out from there. So when it comes to government bond rate, it's not specified which rate. In India, we have government bonds with different rates.
Only 10 years.
No, it's not specified anywhere. If I feel I will take a 5 years rate because the life of my asset is 5 years. No, so we normally try to match it with the age of that asset.
And what about a captive unit? Captive unit which can only sell to the parent unit.
In that case also, right? Now we come to the question, I'll just take another 5 minutes. We come to the question of that real estate. Somebody was talking about real estate. Yeah, can we get the question again?
And it was spread over there that inventory fair value. And in case of real estate, if the assets is being shown as inventory, then how, whether we have to take the fair value of that?
Now, inventory, if you look at the standard, when does this fair value come in? Inventory, even in this standard, will be at cost and net realizable value. When we are doing the impairment testing for the inventory, then we have to take the fair value of those inventory, which needs to be done, say, once in 3 years. So then you consider the fair value of that inventory. And most of the real estate companies, I think, would want to do it at the fair value for the inventory. If you see any signs where there is a major change in the value of the inventory, even though the 3 years is not gone, you can give the reason for the valuation because there's a marked difference, etc. And you can value it at any year within the 3 years. If the prices you feel are going down, if the prices of the real estate are going down in certain areas and in the real estate are going up in certain areas, I can also value them as a group of assets. So for every, like I'll value them as a block. That is not written in the standard, that's what you practically do. Because like in the Middle East, we had a major down phase in the real estate values at the time when these standards were being implemented there. And so the now you're bouncing back because of the Expo 2020 coming up and all. So the companies like Damac Properties, Nakhil, all these people, if you write down such a lot of your inventories, the companies will be nowhere. So in that case, what they did was they tried to bring in a block, then they tried to justify that it's a temporary diminution in value. So if it's temporary diminution, you may not give an impairment credit. So you have to see the scenario at that time. The standard is very clear, you fair value them and then do the impairment.
Hello ma'am. Ma'am, small question. Like whatever is my asset will be liability in someone else's book.
What is mine?
Whatever is my asset will be liability in someone else's book.
Yeah.
Maybe
Both the values will not be the same. The value which will be on your books as an asset, the other person may have a different credit risk perception of themselves and it may be a different value in their books.
Just one.